Hey there, traders. Todd here. Welcome. We're just doing a quick little live stream here Friday afternoon, 2:15. Good rally going on here, and I want to shed a little light from our point of view why the market is rallying against a couple key levels on two other the major macro markets, which is fixed income and foreign exchange. Why that's driving the equity markets. So let's start out here. The leader today is clearly growth, right? If we look at this little screen I have of iShares, various market capitalizations, as well as our growth value orientation. So you can see large cap growth is leading it up 1.7, 1,000 growth, mid cap growth, small cap growth. Then you get to top 200. So this is large cap. So not only are we seeing growth lead compared to value today, but you're seeing all of a sudden large cap start to lead where small and medium cap have been leading over the last week or two. So very broad-based rally, but clearly large cap is leading. Oops, I'm late for a meeting. And large cap's leading and growth is leading. And I think this is the reason right here. So as we look at this chart right here, this is the 10-year US yield. And to get into the nitty-gritty in terms of Elliott and Fib, this is a zone of resistance that we alerted our clients to, which is 4.07 or 4.17 in the 10-year US yield. That was resistance. We gapped up into it yesterday, and then we gapped down this morning, and we're continuing to fall away right on cue. So those of you who follow Elliott, could be an A, B, C expanded flat. That's one of the three Elliott wave corrections of flat. Expanded means B goes below the origin of A, C goes above the origin of B, or the same thing as the termination of A. So new low, trap people, new high, trap people into fib resistance. Now, the other market here is the FX markets, and this is the dollar also in the daily, and you'll see just the possibility that this is a fourth wave correction against the area of the prior fourth of one lesser degree. This is textbook Elliott, as well as a 38% retracement of orange circle 3. So we have resistance. Now, what I want to kind of draw your attention to is look at the shape of the correction of the decline in the dollar versus the ensuing correction compared to the yields. Yields made a high on October of 22. The dollar made a high in September of 22. Look how much more directional the dollar is, and look how much less severe the dollar rally is compared to the yield, the moving yields. Yields are trying to move up, and the dollar is saying, hold on, you're getting a little too ahead of your skis. And obviously, it's not just US yields that drives the dollar. It's yield differentials between us and Germany and Japan and the rest of the world. It's yield differentials. But just for points of this example, you can see the 10-year yield in white, US dollar index, the dollars dropped off a lot more than the yields have, 10-year yields. The yields have rallied more sharply than the dollar have. So basically what's happening is the dollar's saying, wait, hold on. You're getting a little too ahead of your skis. I was just in Park City, Utah on 3 feet of powder. It was awesome. But the FX market is not confirming from a US centric point of view where these yields are going. The yields, as I started with, are into resistance. So, I think what's happening now is we tried to make a run above 4% in the 10-year. We're starting to back off. The move higher in US yields last year relative to the rest of the world drove US dollar strength. FX markets were responding to it. Dollar strength is not good for multinationals, which obviously is going to be, I think, a lot more oriented towards the growth trade and higher valuation stocks with interest rates starting to move up. The idea of holding high valuation stocks becomes much less compelling. Well, again, I don't think it was a yield story. I think it was more of a dollar story. Well, the dollar is not rallying as much now as yields are, as I've already made that point twice. So that's why I think you're seeing a move into growth stocks. And I put out a tweet yesterday showing 4 reasons why the NASDAQ was at support, and here we go. So pulling it all together, if we're going to hold below 4% in the 10-year yield, maybe we now have visibility at 5.25, 5.5 in terms of Fed fund rates on the short term. I think the market now realizes they're not going to cut rates, which I say good. Let's leave rates at 4 or 5%. If inflation can get back below, with a 5 handle, to be great. So now you have break-even money. Is that enough of a reason for people to rotate out of stocks and break even on their money, make 5% on yields, but lose 5%? Which would be great news on the inflation front. I don't think so. So I say leave rates up there. We don't need them to cut rates in order for the stock market rally to continue. This gives the Fed, I think, it's reflective of a more normally functioning economy, where now the Fed has room to cut if another shoe were to drop, which I don't think we need to. I don't think we need to cut rates in order for the stock market to rally. So dollar below resistance on a shallower correction. Yields really tried to make a move up there. Just got stuffed at key resistance. Dollar's not having it. Dollar's trying to give the fixed income market the heads up that you're getting a little ahead of your skis. I'll finish it up here with the NASDAQ. This is our blue count. Let me go to red count. So all the gory Elliott wave stuff aside, the fact remains that we are at the same price as we were in May of 22. Downtrend resistance has been broken, now offering support. There's a lot of things happening in this market that could put us higher. Okay, and plus, not to mention, chips are doing so extremely well also. But we're seeing, we're even seeing some of the beaten down communications and consumer discretionary stocks, even Google and Amazon, and some of these beaten down comms and consumer discretionary names are coming back. So I'm encouraging. We're adding positions at our stock swing desk here at Trading Analysis. I rebalanced the portfolio on the wealth management side to get a little bit more aggressive. I took some short hedges off. We have some cash to work, and I'm considering putting that cash to work. So hopefully that helps. Let me know if you have a question, comment. I'll check everything. I'm streaming on a couple different YouTube channels, Facebook and Twitter, theoretically. So we'll see what happens, okay? Have a great weekend, guys, and I'll see you on the next video.